Now, in the class before that, I don't know if we talked about valuation of ordinary shares with you. Do you have any notes on valuation of ordinary shares?
Yes.
Where we said in valuing ordinary shares, firms are grouped into three. Ya kwanza ilikuwa non-growth firm, where tukasema the PO is simply D1 over what? Over KE, right? Hizo mko nazo, si ndio? For a normal growth firm tukasema dividends and earnings grow at a constant rate to infinity. Na tukasema BO would be equals to the PO would be equals to D1 over KE minus what? KE minus G, which is the same as D1 is the same as DO into 1 plus G. Then we divide it by KE minus G. So I think if you have that one, then that is okay. Then of course, for a supernormal growth fund categorized into two, the value is a total of two components. The present value of expected dividends up to the point of stability and the present value of the shares immediately after stability. Now, in the interest of the two of you, because others are yet to join, can just try to get a question or two to talk about valuation of ordinary shares. Otherwise, leo tulikuwa tuende something else, but maybe God has made those others not to join now so that you can benefit in a way. Now I'm seeing a question in let me go back so that we don't end up repeating what we had covered. Can go huko nyuma nyuma ndo I know if you get the notes you'll be able to compare. So we have the trying to get questions za kitambo kitambo kabisa. Let's see somewhere in 2019. This is November 2019. So you can have a value of ordinary shares. So let's have these. May 2019, question 1C. Although hii pia najua tulifanya maswali kadhaa. The entire lesson ilikuwa kufanya maswali. Kindly let's go. Let's not repeat what we did because you'll get those notes. We can have this question 3C of November 2018. I think that one I gave as an assignment. So November 2018, question 2C. Can do question 2C of November 2018. I think we can look at it. You're told that the earnings per share, I hope we are all be able to see the screen or follow from your respective past papers. November 2018, question 2C. The earnings per share and dividend per share data for Maraba Limited over the last 5 years are provided below. So you have the dividends per share and the earnings per share 2013 to 2017. Then you're told that a prospective investor is considering buying the shares of this company, which are currently selling at 55 each at the Securities Exchange. So the price on the market is 55. The investor's required rate of return is 20%. Advise the investor on whether to buy the shares of Maraba Limited using Gordon's model. We had kindly remind me, we had talked about Gordon's dividend growth model, right? Nisikuwa narudia nafanya chenye tujazungumzia notes zake. The formulas that I've put down up here, are they familiar?
Yes, we did, Mwalimu.
We did those ones. Haya, sawa. So wacha tufanye swali lake. Now, when you look at this question, the dividends are not constant throughout the year. In 2013, dividends is 1 shilling. 2017 is 1.8. So by all means, dividends are growing. And they are growing. We are not told about different growth rates. So you only need to get the on average, they are growing at what percent? So that means in getting our PO, we have to use the DO. We have to use the DO into 1 plus G over KE minus G. And I repeat what I said. Under normal circumstances, the company will always give you the DO, current year's dividends, unless otherwise stated. Akitaka kupa D1, next year's dividends, atakwambia. So therefore, from our question, our DO, if you remember from the definition of DO, tulisema is the most current dividends. The most current dividend is 2017, which is 1.8. Then KE, the required rate of return is 20%, as you can see there, which is 0.2. That's our KE. So you have DO, you have KE, now we need to get our G. So G, where we have dividends for more than 1 year, then the only way you can get G is using the nth root. So remember the nth root, the square root. The nth root of the most current dividends over the most past dividend. You remember that formula?
Yes.
So that is
minus
the
1.
Minus 1, thank you. So therefore, G would be equals to our n, number of years less 1. 1, 2, 3, 4, 5 minus 1. I think the fourth. So fourth root. Fourth root, hii root iko wapi sasa kwa hapa ndani? Kwa computer. So fourth root, the most current dividend, is it 1.8?
Yes.
Dividend ya kitambo kabisa, is it 1.0?
1.0.
So get the fourth root, then subtract 1 using your calculators kindly. So it's 4 fourth root, not 4 times. What do you have? Tuma.
I don't know if I'm correct. Mine is 0.15. 158.
0.158.
Gladys confirm.
Unfortunately, I don't have my calculator. I don't think if I will be able to confirm.
Mm-hmm. Okay, so there we go. I can confirm. Yeah, it's true. 0.158. Now, can we get our PO? So our PO equals to 1.8 into 1 plus 0.158. Can I say 1.158?
Yes.
Then divide it. Let me put it here. You divide all
Okay.
that by KE is 0.2, right?
Mm.
Minus 0.158. 0.158. So check that one out. What do we have?
$49.628. We round it off. 49.63.
So 49.63. Nice. And when you go to the market, wametuuliza to advise an investor on whether to buy the shares of Maraba using Gordon's model. When you go to the market, what is the selling price on the market?
55.
5.
The selling price on the market is 55, right?
Mm.
Yeah.
So anunue ama aache? Are they overvalued or undervalued?
They're overvalued. Hmm?
They are overvalued. So if they're overvalued, you buy or sell? You buy or you don't buy?
You don't buy.
You don't buy. So hence, investor should not buy the shares. So you just tell him that. So they are overvalued, hence investor should not buy the shares. The question is not whether to buy or sell. The question is whether to buy. Sawa. So that's a question on a normal growth farm. Let's see if we can get a question on supernormal. Supernormal na normal ndio inatestiwa. So I'm just trying to get one on a supernormal growth farm.
Mwalimu, hebu check August 2022.
August 2022.
Yes, question 5C.
So we are going to check that one. In the meantime, can you check question 3C of May 2018?
Mm.
as I go to that August that you've just said. Well, let's start with this, then it's just not somewhere that August 2022. Tumalize alafu turudi hapo. So this is May 2018, question 3C. We are told that the profit after tax of Mohendato Limited as at 30th April 2017 was 6.5 million. So that is the profit after tax. When you look at that question, information is all about the past. So information in the past will always give us DO. If it has to be D1, it must be expected next year. It must be futuristic, and not futuristic of 1 month. Next year, the company expects to pay D1. So it's always what has happened unless other is stated. So here we are told the profit was, meaning Nikitambo, last year. The company is quoted at the Securities Exchange and its shares are currently selling for 40 shillings each. The company's dividend policy is to pay out 40% of its earnings for the year as dividend on its 1 million issued and fully paid up shares. No problem. So meaning out of our profit of 6.5 million, dividends will be 40%. We retain earnings will be 60%. We pay out 40, we retain 60. Na tumepewa number of shares, meaning we can get the profit per share, which can also give us dividend per share, which will be the DO. The company's profit after tax is expected to increase by 15% per year for 3 years and 8% per year thereafter. So you see, that concept is now for supernormal. It grows at different rates. Miaka tatu za kwanza 15%, alafu ikuje stabilized at 8%. So present value of expected dividends up to the point of stability. Then we add present value of the shares immediately after stability. So stability is coming after 3 years, where they grow at 8% per year thereafter. So it will grow at 8% forever after the 3 years. Dividends will grow at the same rate as profit of the company. The shares of the company are expected to sell at 64 per share at the end of 5 years from now. So this one will not be there forever. It will be there after 5 years. We can sell the shares and get 64. The cost of capital is 12%. Now let me explain something here. Examiner can bring a question like this one, alafu akuulize, advise an investor on whether to sell the shares after 5 years or to have the shares forever. We'll try to because you are in class, you are learning, try to evaluate the two scenarios. Determine whether the shares of Mohendato are currently fairly valued, undervalued, or overvalued for an investor expecting to sell them after 5 years. So if you expect to sell them after 5 years, we see what you expect to get. So here, for a supernormal growth firm, we have the year. We shall require our D1, which equals to DO into 1 plus what? 1 plus G. Then of course, we shall require our PVIF so that we can get present value. So the figures are in shillings. Cost of capital nimeona pale ni 12%. The present value will also be in shillings. So tuko na year 1, year 2, year 3. Now we have currently, before we come here, there's a working we need to do a small working. So the current profit after tax wamesema ni 6.5 million. Out of the 6.5 million of the profits, we have the number of shares Number of shares, are you seeing 1 million shares? One million shares, ndio?
It should, yes.
So meaning we have the earnings per share. So if 1 million shares are equal to 6.5 million shillings of the profit or of the earnings, how much of the earnings will be equivalent to one share? So you have our profit after tax divided by the number of shares. Profit per share. So which equals to 6.5 million divided by 1 million. And here I'm seeing, is it 6.5?
Yes.
So 6.5 is the profit of one share. Profit of one share. Can we have our dividend per share? Which will be our DO. Out of the profit, the company's dividend policy is to pay out 40%. So out of 6.5 shillings, we are paying out 40% as dividends, meaning we are retaining 60%. We are interested with what we are paying out. So 40% of 6.5. So equals to 0.4 times 6.5. So that is 2.6. Nayo ndio DO yetu tukianza saizi. Hope that I hope sijaenda haraka. Kwa sawa?
Following.
Great. So therefore, as we start our year one, our DO is 2.6. The dividend just for the year just ended. And these dividends are growing at what rate for the first 3 years? I think 15%.
15.
15%. So therefore, our D1 becomes 2.6 times 1.15. So that is 2.99. Tukienda year 2, the dividends at the end of year 1 becomes the dividends at the beginning of year 2. So tunaanza 2.99, still growing at 15%. So there we go. Tukienda mwaka wa 3, tunaanza na 3 point, let's have it in 2 decimal places. Two decimal places. Great. So tukienda mwaka wa 3, what started our year, what the balance at the end of year 2 starts our year 3. So therefore tuko na 3.44 into 1.15. So there we go, miaka 3 za kwanza, year 1, year 2, year 3. Then wakatuambia after the 3 years, the dividends will grow at 8% per year thereafter. Now, unfortunately or fortunately for this question, this person is going to have them for only 5 years. So you need year 4 and you also need year 5. So in year 4, we have 3.95 now, which is now growing at 8%. So times 1.08. So equals to this times 1.08. Tukienda year 5, dividends za year 4, 4.27 ndo zina grow tena na 8%. So equals to this times 1.08. Then after 5 years, huyu mtu atauza hizi shares. Is going to have them for only 5 years. After 5 years ataziuza. So ataziuza na apate pesa ngapi? The shares of the company are expected to sell at 64. So after 5 years, we have the selling price. We call it liquidation price. Liquidation price. Na ata liquidate hizo shares apate ngapi? 64. So therefore, tuna discount. Tuna discount at 12%. Do we check table 1 or table 2? Lump sum or annuity? Lump sum annuity? Gladys, Rahma?
Lump sum.
Table 1, sindio? So 12% 1 year, if I check in table 1, 0.8929, right?
It's 10%.
It's 12%.
Oh, it's 12.
Mm.
12. Wait, Mama. Don't do that. 12% 1 year will be. Is it 89, 29, 0.
8929, year 2.
Yes. 0.70, what? 79.27.
7929.
72.
7972. So 0.7972. Year 3.
7118.
7118. Year 4.
6355.
6355. Year 5 nayo 5674.
5674.
5674. Na year 5 iko mara mbili. Year 5, year 5. Then at the end of the day, you multiply this times this, so equals to this times this equals to this times this. So if I do that, naeka hizi zote, so the total becomes the intrinsic value. Intrinsic value. So there we go.
Mwalimu explain hiyo 5 ya pili.
We are getting after the 5, nitapata dividends year 1 mpaka year 5. Baada ya miaka 5 nitauza hizi shares na nipate ngapi? 64. The shares of the company will be sold at 64 shillings after 5 years. Na hapa swali lilikuwa determine whether the shares are currently fairly under or overvalued for investor expecting to sell them after 5 years. Meaning this is an investor that will be able to get 64 after 5 years kwa kuuza hizi shares.
Okay.
Sawa.
Thanks.
Okay. So we compare that. What is the current selling price? Current selling price?
40.
I think 40.
Yes.
So current selling price is 40.
Yes.
Overvalued or undervalued?
Undervalued.
Under.
So shares are undervalued. As simple as that, and you get your 6 marks. Now, I wanted to talk about the other option. Ile wanakuambia advice on whether he should hold them for 5 years then sell, ama akuwe nazo forever. Now, if the investor doesn't sell the shares, meaning akuwe nazo forever, in that case tutakuwa na, now that is where our concept of a supernormal growth firm comes in, where we'll have these shares forever. We shall have our year 1, year 2, and year 3. Whatever you are making in year 1, 2, and 3, you'll continue making it. Okay? So hizi zitaendelea kukua mpaka year 3. So allow me just to duplicate it here. Those ones will be there. But now, after the 3 years, now, that's why we say the present value of expected dividends up to the point of stability. Then we add present value of the shares immediately after stability. Immediately after year 3 is the beginning of year 4. Beginning of year 4 is the same as end of year. So we bring end of year 3. So we bring in another year 3, but now here we need the PO. We need the PO, which would be DO into 1 plus G. Divide by KE minus G. Divide by KE minus G. So that now, in year 3, our DO ni yenye tuko nayo hapa. It's the beginning of year 4, remember. So shall have DO of 3.95, ile iko pale juu. 3.95. Immediately after stability, ina grow na 8%. So into 1.08. And that one, we divide by our KE ni ngapi? Was it 12%?
Yes.
Right? Minus the G of 0.08. So tungefanya hivyo. So that now this one unafinya kwa calc unapata that figure. Which is 3.95 times 1.08 divide by 0.12 minus 0.08. I having 106.65.
Yes.
106.65. Then we look for our PVIF for year 1, year 2, and year 3. I can see them there. That we check itarudia the same. And this is also another year 3. So year 3 zinakuwa mbili. And now we multiply. This times this. We also multiply just now the normal way. So hizo ziko hapo, we multiply up to there. And now we add, and that becomes our intrinsic value. So if we're asked to advise on whether the investor should sell the shares after 5 years or hold the shares forever, if you hold forever, this is the value of those shares. If you sell after 5 years, this is what you have as the value. So our advice would be, you should hold those shares forever. Because by holding, you end up having a value today of 84.14. Na ukienda kwa soko kuuza saizi, utauza na 40. Was it 40? Utauza na 40. even though hapa huku kwingine pia ukiamua kuuza unauza, ukiamua kununua unanunua na 40, value yake ni 49. So it's not very much profitable to sell these shares after 5 years, but you rather hold them forever. Just have those shares in your forever so that you continue earning dividends. Great. Let's go to the other question that you talked about. Was it 2022? August.
Yes, question 5C. You see if nilifanya makosa. I tried doing it alone.
August 2022. You said question 5C. Okay.
Yes.
So August 2022, question 5C. Koki Limited. So we are told that Koki Limited recently paid a dividend of 3.4. So recently paid, that is DO. DO recently paid, that is DO. The dividend is expected to grow at a rate of 15% per annum for the first 3 years, then 10% per annum for the next 2 years, after which the dividends will grow at 5% per annum to perpetuity. The required rate of return is 12%. So you can see the dividends will grow for the first 3 years, 15%, then another 2 years, 10%. Then after that, they will stabilize at 5% forever. So present value of expected dividends up to the point of stability. So here, I'll borrow this concept. So you have so this one is in shillings. Cost of capital wametuambia ni ngapi? 12%. So this 12%. So you have the shillings there. So tuko na mwaka wa kwanza, wa pili na watatu. As we start our year 1, our DO is 2.5. Growing at what rate for the first 3 years? 15%. So 2.5 times so equals to that. Tukienda year 2 tuko na 2.875 2.88 into 1.15. So equals to this times 1.15. So allow me to push it to 2 decimal places. Good. Tukienda mwaka wa tatu tuko na 2.31, still growing at 15%. So equals to this times 1.15. So miaka tatu za kwanza 15%. Miaka zingine mbili, that is year 4 and year 5, zina grow na 10%. So therefore tuko na 3.80 now growing at 10%. So equals to this times 1.1. Hapa tuko na 4.18 growing at 10%. So equals to 4.18 times 1.1. So you can see for the first 3 years, 15%. For the next 2 years, 10%. After that, they stabilize at 5% forever. So you shall have another year 5. Kama tu hiyo yenye tumefanya hapo juu. Na hii year 5 now stability has come. We now need our PO, which equals to, so you shall borrow this formula. So you can document from your end. So that now our DO is this one, 4.6. Now growing at 5%, 1.05. We divide by, our KE was 12%, 0.12 minus 0.05, the growth rate. So hiyo tunafinya kwa calc tunaipata. So 4.6 times 1.05 divide by 0.12 minus 0.05. I think 69. I think that is what the calculator is giving me. I think I'm right. Rama calculator inakupa
Yeah.
69, si ndio?
Mhm.
Great. So again 12% 1 year, 12% 2 years mpaka 5 years. This was 12%. Tutumie tu hizi. Even if we
Yes.
take, we shall get the same because it's 12%. So sorry, I'm going a little bit faster, but I'll allow you to document. So there you go. Or I'll still share the Excel later. So here you have, we do the same mathematics. And we add. I don't know if that makes some sense ama nimeenda haraka.
Iko sawa.
Iko sawa.
Mm.
And this will be the intrinsic value. Good. I think that's fine. So we can that makes it for the valuation of ordinary shares, valuation of bonds, and valuation of debentures. We can take some few minutes, talk about a small subtopic, use of relative measures. Use of relative measures in valuation. Use of relative measures in valuation. And under that we have number 1, market value added, that is MVA, and we have number 2, economic value added. That is ever. So we start with the first one. So the market value added. Then here you can say it measures the additional value of capital employed, into brackets, the capital gain. Full stop. Next point. It is the difference between, so MVA is the difference between market value of long-term funds, and the book value of long-term funds. The difference between market value of long-term funds and the book value of long-term funds. Then just sema, long-term funds stroke capital employed include equity, comma, preference share capital, and long-term debt. Equity, preference share capital, and long-term debt. So tupeane formula basi, tunasema kuwa ever equals market value of long-term funds minus book value of long-term funds. Market value of long-term funds minus book value of long-term funds. Think kuna swali
Mwalimu,
liuliza.
ever ama MBA?
Sorry?
Is it ever or MBA?
MVA, sorry, not ever. Thank you. This is MVA, market value added. So before we go to a question on the same, let's have also number 2, economic value added. So economic value added. Then under economic value added, that is ever you say, it considers the economic profits. By comparing the net operating profit after tax, the net operating profit after tax, net operating profit after tax into brackets NOPAT. NOPAT, net operating profit after tax. With capital employed as a component of the firm's cost of capital. With capital employed as a component of the firm's cost of capital into brackets WSEC. WS is our next topic. We are starting it on Friday, God willing. As a component of the firm's cost of capital into brackets WS. Sorry, WS in full is the weighted average cost of capital. So mwambie kuwa ever equals net operating profit after tax minus capital employed times WSEC. So when you talk about the net operating profit after tax, so net operating profit after tax equals profit before interest and tax into 1 minus tax. This is just like operating profit is sawa na profit before interest and tax. So EBIT, earnings before interest and tax. Normally kwa income statement tunakuanga na tuko na sales, we less variable cost or we less the cost of sales, we get contribution ama gross profit depending umeless nini. Tukishapata contribution, we less fixed operating costs. Fixed operating costs. So kiless fixed operating cost unapata operating profit. And operating profit ni sawa na profit before interest and tax. Profit ni sawa na earnings. Muka pale nilikuwa na profit per share, earnings per share. So profit before you charge interest. At this point, you're supposed to less interest ama finance cost so that you get the profit before tax. You less tax and you get your profit after tax. Now, in getting the ever, tuna avoid hii part ya interest. So tuko kwa profit before interest and tax, and we simply less tax. If tax is 30%, after tax will be 70%. That's why you're doing 1 minus t. 1 minus 0.3, you get 0.7, which is the profit after tax. So it's the net operating profit after tax. So operating profit, then you adjust for tax. Sawa. That's clear?
Yes.
Great.
Yeah.
So it was tested somewhere, both of them. This December 2024. August 2024. Where did I see it? April 2024. Here we go. Question 5D of December 2023. December 2023, question 5D. Only for 2 marks each. That is okay. Now, we are told that the following financial information relates to Steps Limited for the year ended 30th September 2023. So adjusted net operating profit after tax is 180 million. So tushapewa hapo no part. Total capital is 900 million. Debt does not exist. Remember, capital employed tulikuwa mention pale kwa market value added, tukasema capital employed is the same as the long-term funds, which is equity, preference shares, and debt. Hapo amesema debt high exist. Closing market share price is 29. The total number of shares outstanding is 86. Cost of capital is 13%. Cost of capital is that WSC of ours. Compute the following relative performance. So ever, if we start with ever, our formula is there. So you can see we have our no parts. No part tumeambiwa ni 180. No part ni 180. Then we have give me a minute, please. 1 minute or two. Mnaweza jaribu kuendelea because all the information is there. I'm joining you in 2 minutes.
Gladys, umefanya?
Mi nimepotea hapo kwa work ni
Weighted average cost of capital.
kwa hii nini value yake ni
I'm not sure but nimetumia hiyo cost of equity 13%.
And it's correct.
Thank you.
That's the topic we are heading to. So I expect ni ukikwama, I'm not worried because you are heading there. But you use the cost of capital that is available. In our case, the cost of capital is the cost of equity is 13%. But it's a topic we are going to. So NOPAT is 180, right? Capital employed. The capital that we have voicing 900 million.
Yes.
900 M. And the cost of capital, which is WSEC, becomes the cost of equity, which is 13%, like 0.13. So therefore, ever becomes our NOPAT of 180 minus 900 times 0.13. Na mmefanya mkapata ngapi?
63.
63M. Great. What of MVA?
Hapa nimekwama.
Hiyo imekwama. So market value of capital employed minus the book value of capital employed. I have this one just here. So there we go. So therefore, our market value equals to, do you have the market price of one share times the number of shares? Remember hapa kwa capital employed walisema hakuna debt na hakuna preference share. So our capital employed has to be equity, preference shares and debt. Wamesema debt does not exist. They have not given us any information on preference shares. So meaning our capital employed will be simply ordinary shares. And each ordinary share has a price of 29. And how many shares do we have? 86 million. So market value of capital employed becomes 29 shillings times 86 million, which is how much? $29 times 86. Is it 2494?
94, yes.
And we have the book value of capital employed. I think 900. That's our capital. Right? So meaning our market value added becomes 2494 minus 900. So which equals to
1594.
1594. And that is it. Any swali? So 2 marks, 2 marks. So there is this question that was tested in September 2021. September 2021, question 4D, ilikuwa ya kutisha. It asked about the economic value added. Let's see what it has. Let's see what it has. So I'll put so that we don't waste a lot of time, I'll put my formula there because they want us to get the ever. So let's start by getting our no part. Tutaitafuta tukisoma. Our no part. So from the information, the following financial data relates to Penguin Limited for the year 2020. Assets, current and non-current, financed by debt, equity. So hapa iko na debt. So sales, cost of sales, gross profit, operating expenses, they get the operating profit. So operating profit ndo tulisema ni operating profit after tax, the no part. So out of the operating profit waka less interest. So can we say that our no part equals to operating profit, which is 300 into 1 minus tax rate wamesema ni 30%, 0.3. Does that make sense? Is that fine?
There is 10 and 30. Which one are we using?
There is
30% and 10%.
30% is the corporation tax rate. We need the tax, profit after tax. So if tax is 30%, after tax is 70%. That's fine?
Yes.
So that is our no part. Can we have our capital employed? So capital employed becomes, hapa tuko na equity. Equity yetu ni ngapi? 260. Na debt yetu ni ngapi? 140. Are we all there?
Mm-hmm.
So that gives us 400 capital employed. All right?
Yes.
Then we need our WSCC. Now WSCC is a combination of two components. Hapa hatuna preference shares, it is equity and debt. So WSCC, as we are going to look at it in our next classes that are coming from Kesho Kutwa, we shall have weight of equity times cost of equity plus weight of debt times cost of debt. Cost of debt we have to adjust for tax. Kindly, for today, just copy. Hii concept tutaijua next week. Kuanzia next week. Friday tunafanya introduction, next week tutakuwa tumeijua. So the weight, the value of equity divided by the total of equity. So what is the proportion of equity in the total? KE, tumeambiwa somewhere, the firm's cost of equity is 12%, interest rate on debt is 10. So interest leads to KD. So we adjust for tax. For today, let's just copy this one. So our weight of equity is actually the proportion of equity in the total. 260 divided by 400. That gives us the weight. So 260 divided by the total, which is 400. What is the proportion of equity in the total? And the cost of equity is 12%, so 0.12. Plus weight of debt. What is the proportion of debt in the total? 140 over 400. 140 divided by 400 times the KD. Interest rate is 10%, that is 0.1. but we have to adjust for tax. I'll explain it. 1 minus 0.3. I'll explain it in our subsequent classes. So here itatupea WSCC. So let's try getting WSCC so that we can, that is 260 divided by 400 times 0.12 plus 140 divided by 400 times 0.1 times 0.7, that is 0.07. 0.07. 0.1 minus 0.3, 0.7. 0.1 times 0.7 is 0.07. So therefore our WSC becomes 0.1025. Hii part ndo topic tunaenda, so kama ija make sense achana nayo. So let's conclude our